When people look at their paycheck, they usually focus on the final number and ignore everything above it. That's a mistake. To understand your money, you need to understand what's being withheld, why it's withheld, and which parts you actually control. Let's break down paycheck withholdings clearly. First are mandatory taxes. The biggest one is federal income tax. This is calculated using your gross pay, your filing status on the W-4, your pay frequency, and IRS withholding tables. This withholding is a prepayment toward your annual tax bill. It's reconciled when you file your tax return. If too much was withheld, you get a refund. If too little was withheld, you owe the difference. Next are FICA taxes, which are separate from income tax. Social Security tax is 6.2% of your gross wages, up to an annual wage limit. Once you hit that limit, Social Security withholding stops for the year. This tax is mandatory and not adjusted by your W-4. Medicare tax is 1.45% of all wages with no income cap. Some higher earners pay an additional Medicare surtax, but for most people, it's just the base rate. Like Social Security, this is mandatory. Depending on where you live, you may also have state income tax, and in some areas, local or city income taxes. These are withheld separately and reconciled when you file those returns. Those are the required taxes. Everything else on your paycheck is a deduction. The next category is pre-tax deductions, and these matter because they reduce your taxable income. Common examples include employer-sponsored health insurance, such as medical, dental, and vision. When these premiums are deducted pre-tax, your taxable wages go down. Another major pre-tax deduction is retirement contributions, like a traditional 401k, 403b, or 457 plan. Traditional contributions reduce taxable income. Roth contributions do not. You may also see HSA contributions if you're enrolled in a qualifying health plan. These are pre-tax through payroll and reduce taxable income. Flexible spending accounts, like health or dependent care FSAs, are also pre-tax, but come with strict usage rules. Then there are post-tax deductions. These do not reduce taxable income. Roth retirement contributions fall into this category. You pay taxes now, but qualified withdrawals later are tax-free. Other post-tax deductions can include life insurance, disability insurance, or union dues, depending on how your employer structures them. In some cases, there are wage garnishments such as child support, tax levies, or court-ordered payments. These are mandatory once ordered and are taken after required taxes. Here's the key takeaway. Not everything taken from your paycheck is a tax. Some items lower your tax bill. Some don't. Some are required. Some are choices you made. This is why two people with the same salary can have very different take-home pay. Benefits, retirement contributions, and tax situations all matter. Your paycheck isn't just gross pay minus taxes. It's gross pay minus taxes, minus benefits you chose, minus deductions you're legally required to pay. Once you understand that structure, pay stubs stop being confusing. You can read each line and know exactly what it's doing and why it's there. That's how paycheck withholdings work. In the next video, we'll break down W-2 versus 1099 income and why the difference matters. And if this video was helpful, hit the like button, subscribe, and share it with someone who needs it.